Hello, welcome back to another video with Mind Money Masters. I'm Cameron, and I will be your host again today as we answer the highly controversial question, stocks or mutual funds? How do we decide? What should I buy? What could be the best for me? In this video, we cover the risks associated with both, potential fees and how they relate, and how to do your own research and the method of buying and selling both of these. This video is going to be a little bit shorter than normal since we have already discussed mutual funds and stocks by themselves. Only now we get to compare. Let's get started.
Thank you again so much for watching. Please remember to subscribe to my channel and turn on notifications and see any new videos that are created. Also, if you feel comfortable, please add a comment in the feed on what you liked, maybe what you even didn't like, and what I could talk more about. It really helps me to hear what you're interested in. And as a point of disclosure, all of my opinions are solely mine and not any form of professional financial advice, as I am not a licensed advisor. Please work with your professional advisor before making any investment decisions. You know, I love this quote by Peter Lynch. If you have the stomach for stocks, but neither the time nor the inclination to do the homework, invest in equity mutual funds. Do we believe this? You know, Peter Lynch is an incredibly smart guy. If you don't know him, he is a former fund manager of Fidelity and managed the Magellan Fund. He was able to retire at the ripe old age of 46 based upon his investments. So, really smart guy, really excellent stock market picker. As we go through these next two slides, I want you to take that quote into account and you decide as to whether or not buying stocks or buying mutual funds is the best decision for you. Okay, so here's the quick breakdown side-by-side comparison. One, mutual funds. We talk about mutual funds several times in last couple of videos, but many companies are in one investment. Remember, it's that pool of investments. We've got lots of companies, hundreds of companies in one investment. You don't own any share particularly of one company. You own what is called like a share of the mutual fund itself. Stocks, however, you have ownership in the company. You share in the profits of the company. It's one company that you're purchasing. Say you're going to buy, just for an example, Coca-Cola. Ticker symbol is KO. You own a portion of the ownership and share in the profits via dividends. Stocks and mutual funds could potentially both have fees. Number one, mutual funds have a lot more varying fees than stocks do. Management fees, front-end fees, back-end fees, 12b-1 fees, redemption fees, short-term redemption fees, all of these different fees that mutual fund companies will place onto the investor and basically charge you for getting into their investment. Stocks, really all you got to worry about is commissions. And with so many brokerage houses right now selling stock at zero commissions, might be somewhat more profitable to get into stocks. Mutual funds, they do require less research. That is one good thing. Look at the star rating. We discussed this a little bit on one of the previous slides, the Morningstar rating. It's a rating agency that gives a rating of a mutual fund based on 1 star to 5 stars. Problem with this, however, is a 5-star fund quite obviously says right there on the label, past performance does not guarantee future performance. So a 5-star fund could be a 1-star fund the next month. You don't know. You're picking it based upon past performance, but they say don't pick it based upon past performance. So it's almost like a catch-22. Stocks, however, is going to require some more research. You're going to take your time, just like what we talked about at the very beginning, that first quote by Peter Lynch. We have screening tools. And we have many, many rating agencies. So Market Edge, Credit Suisse, Argus, Ned Davis, and also most brokers give their internal opinion as well. Schwab, for example, it's one of the brokerage firms that I use. Their rating for stocks are between A and F. Schwab rating will cover a mostly fundamental analysis, but Market Edge, for example, covers a lot of technical analysis. Now, we can get into fundamental and technical analysis on another slide. It's not necessary right now, but also realize that brokerage firms will also rate their own mutual funds. Schwab, for example, has a select list of mutual funds that they believe these mutual funds are quality mutual funds. So every brokerage will also rate stocks and will also rate their own mutual funds. One of the major differences between stocks and mutual funds only trade once a day. Stocks will trade multiple times a day. We talked about this a little bit in ETFs. ETFs will trade like stocks. They trade multiple times a day. However, mutual funds, remember, they're open-ended and they're actively managed. So you have a fund manager that is basically buying and selling things intraday for your mutual fund. And at the end of the day, they calculate this net asset value, and that's the end price based upon the results of what the money manager has done during the course of the day. So you can only buy or sell a mutual fund one time a day. Really kind of difficult way to manage risk, right? You can't get in and out of it quickly. Now, this may be beneficial if you're going to, avoid like a knee-jerk sell reaction. But at the same time, there's also no way to get out of it if you see everything tanking. You have to sell at the end of the day, one time a day. Mutual funds, we just mentioned this. There's no real way to manage risk except buying more mutual funds, which that kind of defeats the purpose because you're just spreading it even more over a certain amount of spaces that it doesn't really manage your risk. It doesn't mitigate any risk if the market continues to go down. With stocks, there's a lot of ways to manage risk. You can buy options, which I'll talk about a little bit on the next slide, but also you can sell a stock with a limit on it. So we call this kind of a misnomer. It's a sell stop order or a buy stop or a stop loss is really the terminology that's used. It's not really stopping the loss. I mean, it delays the loss a little bit, but if you think about it, you bought a stock at $50. It goes up to $65. It's hovering right around that 65 mark, and you're a little worried about whether or not it may drop a little bit. You can put in an order to sell if the stock drops to 62. So that's a sell stop. Basically, if the stock drops to 62, it's going to execute a market order at whatever the next available price is. So you keep your gain of that $12 automatically, and it will allow you to get out of it. And so if the stock continues to drop, you don't lose your gain. You don't have that option in mutual funds. Just something to think about as far as a quick breakdown, because risk management, as we've talked about many, many times, is huge. I love the idea of options. I'm a huge options trader. I love trading options. Now, you can trade options as just a hedge. You can use it as an insurance hedge. Same scenario. You bought the stock at 50. It goes up to 65. You can buy what's known as a put option, which gives you the option to sell at a certain price. And you can buy that put option at a $62 strike price. I'll go into more options. I think I'll do another video on options actually here in the near future. But if you buy that option at $62, if that stock continues to fall back down to 45, you still have the option to sell that stock at 62 because that was the strike price that you bought your option on. Now, obviously you got to buy another investment thing, so it's going to make a little bit of a difference as far as your total cost and total outlay. We already talked about stop limits, stop loss orders. The other thing that I really want to make sure that you understand is financial advisors don't really have that much more access to information than you and I. They learned and got their degree, or not their degree, but they've got a certification, and maybe they have a CFP, maybe they have an AMS, maybe they have a number of all these designations that are highly valued and super important in the financial industry. However, from a general knowledge perspective and a general education perspective, they don't really have much more access to stuff than we do. If they had access to more than we do, it'd be insider trading. So one of the things you also need to consider is alternatives. ETFs we've mentioned a little bit. ETFs are basically the basket of a mutual fund, but you can trade it like stocks. And you can also buy options on it so that you can protect your downside risk. Liquidity in stocks is a way to manage your downside risk, along with options, stop loss orders. These are things that stocks offer that mutual funds don't. Stocks are also ownerships in a company, mutual funds are not. Financial education, I firmly believe, as I've mentioned many times before, is key to creating the actual diversified portfolio. If you want to invest in mutual funds, fine, invest in mutual funds. If you want to invest in stocks, awesome, fine, invest in stocks. Understand, though, what you're doing and what you're getting into. I notice so many people get into this cryptocurrency craze. And, I blogged about cryptocurrency. I invest in cryptocurrency myself. But know what you're getting into. Understand the ramifications and the potential risks associated with every investment that you get into. Paper assets, like we talked about, the stocks, the bonds, the mutual funds, ETFs, options, these are all paper assets. That's only one piece of the pie. You got 4 asset classes. Those 4 asset classes are paper assets, commodities, real estate, and your own personal business. the business side is huge. You have to have multiple sources of income. You have to have your own business. Think of it this way. If you want to be able to fund future investments, it would be good to have multiple sources of income where you can actually have a couple different accounts that you can play with. You can have one account that's just highly risky and highly volatile, and then another account that's just like, well, it's super conservative, it's only bonds, it's only gold, it's just certain hedges that are very, very basic. It's very conservative, okay? Whether you are buying mutual funds for the long term or you're trading stocks intraday and ETFs, a second or third or fourth source of income can fund all of these additional side hustles. Now, the wealthy have 5 to 7 streams of income. 5 to 7 streams of income. If you're only focused on your paycheck, that's a little scary. Get a second source of income, third, fourth, fifth, whatever, via a home-based business. You can make money in online marketing with as little as 30 minutes dedicated per day. I personally have done it. I know you can. So if I can do it, you can do it. I have the link in the for the program in my bio. And actually, it's in the description as well. So please subscribe to my channel, leave a comment, like this video. Really, really appreciate all of your input. If there's anything that you would like me to talk more about, please let me know. Also, I have all of my social networks posted on the YouTube description. So if you want to follow me on Facebook, Instagram, Pinterest, LinkedIn, Twitter, please do so. Thank you so much for watching my video. I really, really appreciate it. Cheers to your success and happy trading.